And joining us now on the trading day ahead, Vince Lorusso, President and CEO of Clough Capital Markets. Good morning. Good to see you.
Nice to see you too, Joe. Thanks for having me.
How was yesterday? How did you factor into that number and then go back? That's the third straight hotter than, or at least rising number in inflation. Were you counting on rate cuts this year, Vince, for a bullish thesis?
Yeah, Joe, we look at the trends there on a longer duration than just a month or two. There's always going to be some distortions in the data. And frankly, when we step back and look at the capital markets, we think that a lot of the trends for equity investing are very favorable, right? Inflation, despite coming in slightly ahead of expectations yesterday, I mean, really, it was more or less a rounding error when you carry that out a decimal point. But broadly, you see inflation coming from kind of 9% down to the low threes. We feel really good about that as equity investors with a longer time horizon. Economic growth is still sound. It's not very high, but we're seeing growth, a strong labor market. We think the deflationary trends that are largely driven by demographics are still intact. And in fact, tariffs may play a role in lowering inflation. As tariffs potentially play out and the retaliatory effects of tariffs, we're not overly concerned about inflation. In fact, we think inflation will continue to trend down. Rates on the short end could trend down, and that makes us really bullish on equities.
So there are things other than tariffs that are, you mentioned demographics. Is it a pipe dream, Vince, to think that reining in some wasteful government spending and fraud could, in the long run, give us better inflation a better inflation picture? Is it possible, or is that just too much? I mean, the market couldn't sniff that out early, could it?
Well, Joe, it seems like there might be, a ample area there for some savings, and I would think that that's good for overall productivity in the economy, right? So there's never one thing, but if you think about the potential for potentially a more lean, government budget, that seems conceivable. It might be a pipe dream. It might take a little while, but I think on the margin we'll see some improvements there. I think the bigger driver might be technological innovation, right? As we're all talking about AI and the impact that's going to have on the labor force, but ultimately it could be part of that, again, deflationary pressure, increases in productivity. So we feel pretty comfortable with several of the underpinnings of equity investing, and that's what's had us bullish on equities for quite a while. So even though the Fed, whether they're going to cut this year, to the degree to which they're going to cut this year, nothing has seemed to preclude equities from doing well. And again, Chuck Clough as our chairman and CIO has a long history in analyzing the capital markets here. And we step back at those big underpinnings of demographics. What are the trends with balance sheets, money supply? And this is a really constructive, backdrop for equities. If the federal government can pitch in a little bit and find some savings here or there through the Doge Committee, I think that the markets would actually welcome that in the long run, Joe. But in the short run, I think owning equities makes sense and probably having some active management exposure. And that's talking our book a little bit. But I think it's important to be a little bit more nimble right here, look for areas of the market that are doing well, and find specific securities that we like.
The power of the internet initially was underestimated. And you think about what that did for inflation in terms of price transparency in Amazon, things like Uber, things that you just look at, it's just, that probably gave us the reason we had 40 years of disinflation since Paul Volcker. Part of that was technological. If AI is truly as powerful as we hope, maybe you're right. Maybe that could be a very powerful force for productivity without inflation.
I think we're already seeing it, Joe. Just anecdotally in our day-to-day lives, we're all using that capability more, and you're learning more about the businesses that are integrating AI capabilities into their services. It's why when you look at our portfolio and, CloughETFs.com, we're pretty public about what we own and what we like. We're migrating towards some of the software type platforms where they have a user base, they have a balance sheet, they have a revenue business model, they're generating cash flow. And now here they are layering on some of these AI capabilities to optimize, whether it's delivery or routing or pricing power, being more targeted. And those types of efficiencies play out over many, many years, right? There's kind of the knee-jerk reaction to rush into the semiconductor companies and the manufacturers, the fabricators, the designers. That makes a lot of sense to us in the short run. But I think, Joe, to your point, you step back and look at the long-term implications of this. It will touch every industry and every sector. And I don't know about the analogies to, electricity and the printing press and trains, but But it's safe to say that this is one of those generational investment opportunities. So whether it's the internet that you mentioned or mobile phones or cloud computing, here we are again with an investment opportunity that's going to create, some really interesting upside for some of the securities that we follow. And of course, it's going to dislocate and disrupt some other companies. Again, that speaks to the benefit of being active and having a hedged portfolio mindset and being able to see where, these changing tides play out at a sector level and at a company level.